Hey everyone, welcome back to Corporate Decoder, the place where we dive into the nitty-gritty of corporate filings. Today, we are unraveling Walgreens Boots Alliance's latest 8K report. It's a bit like watching a magician pull a rabbit out of a hat, except instead of a rabbit out of a hat, it's financial maneuvering and debt repayment. And instead of a hat, it is a Securities and Exchange Commission filing. This 8K form is basically a company shouting, hey, something important happened, and we need to tell everyone right now. In this case, it's about how Walgreens is handling its debt. The date of the report, or the date the event happened, is April 24, 2025. All right, let's get into the meat of the report. It looks like Walgreens, through one of their subsidiaries, made some moves to handle its debt. This section talks about ending a significant agreement. Here's what happened on April 24, 2025. A subsidiary of Walgreens called Wilmot Retail LLC created a way to borrow money using their accounts receivable, which are basically unpaid invoices. They set up a facility, kind of like a credit line, that lets them borrow up to $2.5 billion, then call this the accounts receivable facility. So what did Walgreens do with this new pile of cash? Well, they used it to pay off some old debts. They completely paid off 2 term loan agreements, which are just fancy names for loans with specific repayment dates. The first one was a $1 billion loan they took out in August of 2023. It was due in November of 2026. The second one was also a $1 billion loan, but this one was from December of 2022 and was due in January of 2026. They terminated or ended all commitments under these 2 old loans. In simple terms, Walgreens took out a new loan for $2.5 billion to pay off 2 older loans that totaled $2 billion. Now, why would they do that? Well, sometimes it's about getting better interest rates, more favorable terms, or simplifying their debt structure. It's like refinancing your house to get a lower monthly payment or a shorter loan term. Now, let's step back and look at the bigger picture. Walgreens is a massive company, and managing debt is a normal part of their business. This move suggests they are actively working to optimize their financial situation. By paying off these older loans, they might be aiming for lower interest payments or more flexibility in the future. It's like cleaning up your financial house to make it easier to manage. However, there are some downsides to consider. Taking on more debt, even to pay off existing debt, increases the company's overall financial risk. If Walgreens faces unexpected challenges, like a slowdown in sales or increased competition, it could become harder to repay the new loan. It's a bit like taking out a bigger mortgage. You have more at stake. On the other hand, this move could free up cash flow. By potentially lowering their interest payments, Walgreens might have more money available to invest in other areas of their business, like new stores, technology, or marketing. It's like having extra money in your budget to spend on things you enjoy. From a Warren Buffett perspective, we should consider whether this debt restructuring makes Walgreens a more attractive investment. If the new loan terms are significantly better than the old ones, it could improve the company's profitability and make it a more solid long-term bet. But if the terms are similar, or the company is simply kicking the can down the road, it might not be a game changer. Walgreens' strategic priorities are always worth keeping in mind. Are they focused on expanding their healthcare services? Are they investing in their online platform? These kinds of decisions can have a big impact on their ability to generate revenue and repay their debts. So what does all of this mean for Walgreens shareholders? Well, it's a mixed bag. On one hand, the company is actively managing its debt and trying to improve its financial position. On the other hand, taking on more debt always carries risk. It's like walking a tightrope. You have to be careful to maintain your balance. Overall, Walgreens' debt management strategy seems like a reasonable approach for a company of its size. By taking advantage of market conditions and refinancing its debt, it's trying to position itself for long-term success. But as always, investors should keep a close eye on the company's financial performance and risk factors to make informed decisions. And thanks for watching. If you enjoyed, please subscribe, like, and comment.